Hi, welcome to Chapter 3, where we'll be talking about financial statements and ratio analysis. Now, when we talk about the Stockholders Report, there's a couple of things that we need to make clear. One is that the report is going to give information on financial statements. And the financial statements need to be developed from GAAP, which is generally accepted accounting principles. And this is authorized by FASB, or the Financial Accounting Standards Board. So this is just a way of standardizing and creating a set of guidelines to help prepare financial statements and financial ratios so all companies are comparable and using similar techniques as far as their accounting. Now, if you're a public company, you definitely are going to want to have an accounting oversight board to review your financial statements and your financial reporting to make sure that it's consistent, it's correct. A lot of companies will also need auditors to also audit their financial statements. So within this Stockholders Report, there'll be what's called a letter to shareholders. So this is a communication from management to the reader. And it's going to describe the events that managers feel were important. And, it's going to try to put the company in perspective and organize, their efforts for the past year and their successes, maybe some of their failures. We discuss the management philosophy, how the corporation is governed, their different strategies, and what they plan to do next year. So it's really, if you're going to analyze a company, or if you own a company, or you have stock in a company, you always want to read this letter to shareholders to get an idea of what management is thinking. And it's not particularly long, but it gives you a good idea of where the managers or the management of the company is coming from. Then you're going to go into the key financial statements. So even though companies have many financial statements they publish during the year, there are 4 key financial statements that you want to review and include in a stockholders report, sometimes called an annual report. So this is going to give a good overview of what's happening at the company and what has occurred, financially, accounting speaking. Now, the income statement, I feel, is one of the most important statements. And it's going to provide a summary of the firm's operating results for a specific period, whether it's a quarter or a year or a month. It could really be any period. It could be for a day. But typically in a stockholders report, it's going to be an annual focus. So we generally look at these public, statements, especially the income statement, would either be consumed most commonly in a quarterly or annual statement. And it's going to look at, it's going to come from the point of view of the company's calendar year. So some companies' calendar year are January through December, although it could be March through February. So each calendar year can be very different. So, not every company uses the calendar year of the actual calendar as their calendar year. So they could vary as far as when they want their year to start and year to end. And typically, since most companies have the year start in January and end in December, it could be very competitive time. And it's also difficult to close out your end of your year in December with all the holidays. So some companies choose to shift their calendar year, start of the calendar year to end of the calendar year, to different months during the year. Some companies may want to shift it to periods where they're not as so busy. So December, because of the holidays, may be a very busy period for some businesses, and they might want to shift the closing and year end into the end of January or February, where things are slower. Now, with the income statement, it's sort of like for an individual, it'd be most similar to what you would say would be a paycheck stub, or a payment statement for your wages. So a company is going to list the revenues, it's going to list their expenses, it's going to list their operating profits, their net profits, their taxes, their interest expenses. And this is what we're going to use, to get an idea of how the company is performing income-wise. Now, It also is going to look at and show the dividends per share. So this would be the cash distributed to shareholders during that period. And that's a very important aspect of the income statement. So let's look at an income statement here. So let's look at 2019 versus 2018. So it's very common to include the current year and the previous year to see, we want to really see how things are improving. So we see that revenues have gone up, gross profits have gone up, operating profits have gone up. We can look at selling expense, general administrative expenses. These are salaried positions generally that are not working directly with the product, like marketing, finance, accounting, human resources. Depreciation expense, which we'll talk about later. And then we're going to, the gross profits are just the sales minus the costs of the goods you're selling. The operating profits are after the expenses of running the business. This is what the business is generating. But the net profit's going to look after they pay taxes and after they pay interest expense on their loans, pay the preferred stock dividends. Then we're going to get our earnings per share and then our dividends per share. So earnings per share is simply the earnings available to common shareholders divided by the outstanding shares. Dividends are a policy. They're going to be set by the management regarding how many dividends they want to pay. Let's move over to the balance sheet. So balance sheet is sort of a factual financial position at any given point in time. And it's only good for that point in time because it changes on a daily basis. And we like to organize the balance sheet as far as most current assets, most current liabilities, long-term debt, paid-in capital, and statement of shareholders' equity. So we sort of list these facts. So the balance sheet is really broken up into assets, liabilities, and equity. So assets should be, think of a seesaw. So assets would be sitting on one side of the seesaw. Liabilities and shareholders' equity would sit on the other side, and they have to balance. The seesaw should be totally level. So they need to balance. So when we see total assets here of $3,597, when we look at total liability and shareholders' equity, it needs to be the exact same amount. And that's why those two sides balance. Because the assets listed in order of most current to longest term is going to look at the current balance of these accounts. Starting out with cash, inventory, accounts receivable, going to land, building equipment, furniture, vehicles. We get our total fixed assets, total current assets together. Once we take away depreciation, we get our net fixed assets and then our total assets for all. So all these assets are going to have to be purchased with, for the most part, cash. And cash can be generated from profits by running the business or by borrowing money. So that's where liabilities come in. This is more looking at money that's been borrowed or money that might be owed for the company. And then the equity is when stock is purchased, that's going to develop a fund of equity for the company, and also any earnings the company makes gets piled into retained earnings. So this becomes the basis of where the money came from that paid for the assets, and they must be in balance. And again, you typically look at last year versus this year to see the changes at each of the accounts. Now, if we look at the statement of retained earnings, this is important because we get to see how much of the profits the company is earning do they pay out as dividends, or do they retain in the company to utilize for reinvesting in the company. So it's a very simple statement where we have last year's retained earnings balance. We add any net profits for the year, take away any preferred stock or common dividends, and then subtotal will be the total dividends paid less the retained earnings and net profits, and we get our balance and retained earnings for the year. So since they didn't pay out all their money, all their profits in dividends, their retained earnings grow. And this is the money that the company has to reinvest in new projects and new capital projects later in the year. Now, the fourth statement would be the statement of cash flows. So this is looking at the change of accounts to get an idea of how the cash flow is progressing. So the idea is if you buy new assets, it's going to subtract your cash from your cash flow. If you sell some assets, that's going to increase your cash flow. So we want to look at how the cash flow of the company has been affected during this period of over a year or a quarter, depending on what you're looking at. So here's a typical cash flow statement. This is basically a summary of the cash flows over the particular period, like I said, 3 months or a year. And it's going to categorize the cash flows into operating cash flow, investment cash flow, and financing cash flow. So the first one we look here is the operating cash flow. And that's going to be the results from actually running the business. And so it's going to be companies selling their goods and services, paying wages, and it's going to reflect the flow, both positive and negative. So when we have profits, the company makes profits, that's a cash inflow. Now, depreciation might be something you're not used to in your everyday life, but what companies do is they deduct depreciation off their income statement. You see here from the income statement, depreciation expense of $239. And what that does is it's an expense. So if your income, your profits are $986, this gets added into your expenses and your operating profits become $418. But this depreciation expense is a non-cash charge. We're just logging in the devaluation of assets due to the age of the assets. So that's an expense that we utilize to reduce our operating profits, to reduce our tax liability. But when we get back to the cash statement, the cash flow statement, we add that depreciation, that $239, back into our profits as a cash inflow because it's a non-cash charge. We'll talk more about depreciation later. Now, if there's an increase in accounts receivable, any asset, accounts receivable is an asset. So any increase in an asset is a decrease in cash. Any decrease in an asset, like inventory, is an increase in cash. So why is that? Well, if you decrease inventories, you must be selling them, so that's going to increase cash. If you increase inventory, you must be buying inventories, it's going to decrease cash. Now, accounts receivable, it's an asset. So if you increase accounts receivable, that means you're lending money to people that owe you money. So you're lending money on account, which means that you're going to have to use your cash to lend to them. But it's an asset. So as the asset grows, your cash flow is going to decline. So anytime you're using cash to buy an asset or increase an asset, cash flow decreases. And whenever you decrease an asset, so if we decrease accounts receivable, that would be being paid back and cash flow would increase. So it's very simple. Just remember, any assets that are increased decreases cash flow. Any assets that are decreased increases cash flow. Any liabilities like accounts payable that are increased will increase cash flow. Any liabilities that are decreased will decrease cash flow. When you decrease liability, it means you're paying it back. It's, of course, going to decrease cash flow. So this is how we calculate our operating activities in the cash flow. Now, our investing activities is when we take our cash and we buy things like assets, fixed equipment. We may be buying land or buildings. So this is going to be a decrease in cash flow if we're buying fixed assets. Now, finance activities, if we pay back our borrowed money, like we pay back some notes payable, it decreases our cash flow. But if we increase our debts, for example, we're increasing long-term debts here, we increase our cash flow. Any change in stockholders' equity, we may issue more equity to raise cash, or we may buy back equity to reduce cash. Dividends paid will reduce your financing cash flow. So this is, again, cash flows from our financing activities. Now, what's most important is understanding the cash flow and how the cash flow is generally generated. So if we look at inventory, it's a year-over-year change to figure out if inventory increased or decreased. So if we go back to our balance sheet, we see that from 2018 cash flow inventory went from 300 to 289 in 2019. The difference is a reduction or decrease in $11. These are in the millions. are in the thousands, because you see these, when it says parentheses 000, it means to add 3 zeros to the end of all these numbers. And that is to help to, shorten the numbers to make them display better. But anyway, inventory went down by 11. And then when we look at the cash flow statement, we see inventory decreased by 11, but it's an increase in the cash flow. Okay. So it's that year-over-year change, mostly in the balance sheet, that helps us figure out if assets or liabilities have increased or decreased. Now, at the end of the stockholders report, it could be called a shareholders report, a stockholders report, or an annual report. All three of those names mean the same thing. But towards the end, there'll be notes on the financial statement. So these notes on the financial statement are going to include key pieces of information or financial disclosures, which is going to provide further detailed information about different changes in accounting policies or procedures, how they calculated certain numbers, different underlying entries in the financial statements that may need an explanation, different issues that they might be facing as far as how they recognize revenue, if they change the way they recognize revenue, if they change the way that they look at their income and how they pay the taxes, how they break down or organize their fixed assets, their debts or their leases, how different regulations or changes in laws might affect their financial statements. This all included here in the notes to the financial statements. So these are things that financial statements, some changes in the financial statements may not occur due to changes in the actual business, but changes in the way that the businesses are being recorded. So it's always important to read over and understand that the notes to the financial statements. Now, if you have a company that is a company that's a large company involved in operations around the world, you may need to consolidate your financial statements. So you might have to consolidate operations in foreign currencies, and you might have to bring them all into, think of a global company like Sony, and you want to bring it all into a US-based total set of financial statements. That's when you're going to have to consolidate. And generally, you're going to use FASB Standard 52 to help understand how to translate foreign currency denominated assets and liabilities into the parent company's financial statements. And because there's certain techniques that you're going to use for the foreign currency translation. So when companies are operating in foreign countries, are most likely operating in a foreign currency. And there's a specific way that any assets, liabilities, or sales or operations can be consolidated and converted back into the financial statements in a dollar rate using a current exchange rate. So this could be tricky and something that definitely needs to be researched by a company, and then whatever methods they choose to consolidate, they usually have some flexibility. They need to stay consistent with that method. Now, let's move over to financial ratios. So financial ratios is a way of more quickly interpreting and comparing financial statements either between different companies or between different periods for the same company. Now, it's a method of evaluating the performance of a company in a more simplistic basis that puts things in a ratio that are comparable. So instead of comparing, when you're looking at two different companies or two different sizes, it's hard to really compare their progress. But if you convert them into financial ratios and do a ratio analysis, they become a lot more comparable. So who would be interested in these financial ratios? Definitely shareholders, creditors, and the management of the firm are all going to try to use these financial ratios. Shareholders are going to use the financial ratios to judge whether or not they should buy more of the company or sell the company, or just get a better idea of how the company is performing. So the shareholders like to focus on things like cash flow and profitability, dividends, and how that's going to affect the share price of the stock, or how they could use that to predict the future price of the stock. Now, creditors are people who lend the company money, And they're going to be interested in the liquidity of the company and the financial solvency of the company and the financial strength of the company to be able to determine if the risks are appropriate for the interest that they're collecting on these loans. Now, management of the company is going to focus on the company's financial situation and monitor how the company is improving year over year and use it hopefully to help make decisions to improve the company over time. Now, as far as using the ratios to make comparisons, we could do a cross-sectional analysis where we're going to look at, the interpretation of the financial ratios, and we want to understand how different firms are going to compare to each other at the same point in time. And hopefully firms within the same industry, because different firms in different industries are going to have, different specifics on their financial ratios. So if you look at companies within the same industry, they'll be a lot more comparable because they have similar business structures and similar sales structures. Benchmarking is a type of comparison where we're looking at just the company's financial ratios over a specific period of time in comparison to a key competitor or a group of competitors. Sometimes when we do this benchmarking, we might take the industry average. So we could take the industry, say there's 10 stocks within the industry, we can create an industry average, and we can use that as a benchmark. Are we doing better or worse than the industry average? Or we could take a key competitor. So maybe if, you're Burger King, you're going to look at McDonald's as a benchmark to do a ratio analysis to compare how you measure up to a key competitor. A lot of times you'll use the average to get an idea of how you compare to the average of the industry, or you'll find one specific key competitor to do a benchmark against. Okay, so if we look we look at the computer industry. This is Apple, Hewlett Packard. We could look at the retail building, home improvement, Home Depot and Lowe's, so we can get an idea of how their different ratios measure up across the board, and which companies are doing better, which companies are doing worse. We could look at grocery stores like Kroger and Whole Foods. Whole Foods is no longer broken out because that was purchased by Amazon. We could look at merchandisers like Target and Walmart. So these are, key competitors. So they might want to find your closest competitor to compare how your financial ratios are measuring against their financial ratios. We can also use the time series of financial ratio analysis, where we want to look at how a company's been performing over time. So let's look at the last 5 years, and we can see in different financial ratios, are they improving over this 5-year period, or are they declining? And hopefully we would want to figure out the reason why we see any large differences. It could be a situation where, wow, in this particular year, all the ratios have changed a great deal. Why is that? Well, there was a merger that occurred, or an acquisition that doubled the size of the business and brought in new business lines and new business units. So there's, the financial ratios oftentimes need to be combined with some explanations when there are big changes in a time series. Now, a combined analysis will combine a cross-sectional with a time series analysis. So that would let's look at all the different competitors in a time series analysis. So it's a more complex analysis looking at the two together. So here we could have, if we're doing a combined analysis, we have 2013 to 2016 for the industry in red and American Airlines in blue. And we can see how did American Airlines, how was their net profit margin compared to the industry. So they definitely about 2014, 2015, they surpassed the industry, but in 2016, they were less profitable than the industry. So this is a good graphical representation of a combined analysis. And it's very powerful because you get a time series and you get a comparison through time with the industry. And it's always good to do this graphically. It's a great way, as you can see, to visually understand. Now, there are some cautions about using financial statement analysis that we have to remember. So when we see very large changes from the norm or average, this could possibly show us a problem in the company that needs investigation. But there's no single ratio that is going to be 100% of the focus should be in. So, when we're looking at these different ratios, we don't want to judge the company just on one ratio. It's a holistic approach, looking at all the different financial ratios to get a better idea of the company. Now, it's also important to have the correct period of time. So when we're looking at financial statements for the year, and we're looking at calculating between different companies, we want to have the time or the seasons aligned, or it could throw off some of the usefulness if the points in time that we're reviewing are way off. So of course we want to compare Walmart's 2019 financial ratios to Target's 2019 financial ratios. However, they may have to be reconstructed if their annual years are different from each other. So if Target has their annual year starting in February and Walmart has their annual year starting in July, the financial statements should theoretically be reconstructed to construct the same period for both companies, so they're more comparable. Now, it's preferred to use audited financial statements and ratio analysis. So you want to have the financial statements that are audited from a legitimate auditing company so that you can have a certain amount of confidence in those financial statements. And typically, it's a requirement for most companies to have their financial statements audited. Now, the financial data being compared should also be constructed using the same set of accounting principles, such as GAAP. And this is a help to keep the accounting systems or treatments in a similar way so that the ratios don't get distorted. Because there are many different ways and many different accounting systems you can use to organize your company's books. But using GAAP, even within GAAP, there could be some interpretation or different ways of recognizing revenue, or how fixed assets are treated, or how depreciation is treated. So sometimes a deeper dive into those differences between competitors need to be looked at as well. Now, we also want to worry about how inflation can distort results. So over time, if you're looking at financial results from the year 2002 compared to the year 2022, that's a 20-year difference. So there's a significant amount of inflation in those 20 years that are going to make the sales in 2022 look different than the sales in 2020, even though they might be very similar if you readjust for inflation. Same thing with assets. Older assets may appear smaller because they were purchased at a lower price compared to buying the same asset today. For example, if a company bought a utility truck in year 2002, it might have been $20,000, but today it's $40,000. So the appearance in the financial statements through time, inflation is a distorting effect that can be compensated for when you're doing financial statements. You can modify the financial statements and right size them for inflation if there's particularly long periods of time, like 10 years or more. In most cases, we're looking at a year over year, or the last 3 to 5 years, inflation isn't as big as a concern. And I just want to reinforce that no single financial ratio is going to tell you the full story of a company. You have to analyze the financial ratios together as a set. And generally, we take these financial ratios and we put them into 5 distinct categories. So we're going to be looking at assets, liquidity, activity, debt, profitability, and market ratios. And we're going to calculate these ratios utilizing the income statement, the balance sheet. Those are going to be where we're getting our base information to calculate these ratios. And in the next section of this lecture, or part 2 of this lecture, I'm going to start off where we're going to look at some companies. We're going to start with their financial statements, and then we're going to work through the different financial ratios, get a better idea to interpret how the performance of this company has been over time. Okay, so I look forward to talking to you in part 2 of this lecture.